I'm Richard Goncalves. My guest today is Roger Montgomery from Montgomery. BHP, Rio Tinto, what's your take on those stocks?
Yeah, I listened to the analyst's way of looking at things, and it's becoming more and more foreign to me as time passes. And I just don't get why people aren't thinking about what these businesses are worth 2 or 3 years out and basing their investment decisions on that. I guess if you're trying to make money over 2 months or 3 months, well, maybe that stuff's important. But if you're trying to buy great businesses and generate a return that's strong and stable, that you can sleep well at night, well, it's not the way to operate. When I look at both of these businesses, right now, today, both of them are expensive compared to their value today.
Okay.
So, for example, BHP, 41.50 is the price, its value is 36.44. Rio trading at 69.88, and its value is let me have a look here, 51.61.
Okay.
So BHP is closer to its value, but a premium. Rio is a long way away from its value. And here's the clincher for me: Rio has more debt and a lower return on equity. BHP has less debt and a higher return on equity, so it gets the tick in terms of business performance and quality of balance sheet. And BHP's intrinsic value in 2 years' time is higher than the current price, whereas Rio's intrinsic value in 2 years' time is the current price.
Okay.
So if you're going to buy Rio today, in 2 years' time the intrinsic value would be what you pay for it today. So it'll just catch up, whereas BHP's goes ahead.
Okay, let's get your analysis then on the banks right now. But to balance it out, let's see what the brokers are saying about the Commonwealth Bank following its $2.94 billion interim cash profit. So the Commonwealth Bank and the banks in general, the theme that I get to see there anyway is that they say, these brokers, the instos, say that the CBA is expensive. It
is expensive now. It was here on this network, might not have been on your program, but it was on the network that I mentioned that I favoured the CBA, and I think it was around September last year. I thought the CBA was going to be the best performer. And in fact, if you have a look at the return on equity of the CBA, it's significantly higher over the next couple of years. It's forecast to be significantly higher than the other banks. So the CBA is sort of circa 20% returns on equity. Westpac, you're talking 14 to 17%. National Australia Bank, 11 to 13% return on equity, and the ANZ, 12 to 14. So the CBA stands head and shoulders above the other banks in terms of its economic performance, but it now appears as though it's factored into the price.
So are any banks relatively cheap?
Well, believe it or not, Westpac, NAB and ANZ, if you're happy owning the inferior banks in terms of economic performance, well, all of them appear to be at well, perhaps the biggest discount is Westpac,
right,
to its intrinsic value. In fact, the intrinsic value this year for Westpac is, let's have a look, $26.37, and it's trading at $23. So it's about a 10% discount to its intrinsic value. No discount to intrinsic value at the National Australia Bank. It's trading right on what it's worth at the moment, although its value is expected to go up over the next couple of years. And if I have a look at the ANZ is about 4 or 5% discount to its intrinsic value, and that value is going up. So all the banks, look, I've said this before, if you live on an island, you want to own the business that charges everyone on the island to get their money in, to get their money out, to ask how much money they've got, to do anything with money the banks seem to be able to charge, and they're great businesses to own on an island. So I think it's a terrific oligopoly that you want to be a part of. It might not be so great if you're a consumer, but it's terrific as an owner. But the CBA now does appear to be expensive.
Telstra is an interesting one because there's views all over the place as to whether or not it's providing good value. A lot of people seem to buy it for the attractive yield, which is 14 cents announced today. But based on your valuation methods, do you like it?
If you buy a business, and this isn't the case with Telstra, but if you buy a business with low return on equity, then eventually, even though it might have an attractive dividend, you're going to lose money. Because any money that it doesn't pay as a dividend, any money that it retains, it's going to destroy wealth for you. Now, Telstra's a classic. Nothing surprises me about the Telstra statements today.
Right.
And Look, I think it's really, really easy to work out a good business from a bad business, and and I'd love to be able to plug the book, that's coming out. If
Name
people,
of it?
well, it's called Valuable or Valuable. It's a play on that. If people go to rogermontgomery.com, they can register. I'm only doing one print run around the end of March, and that's going to be it. So, but Telstra, I talk about Telstra in the book. 10 years ago, it earned about what it earned this year. It's earned roughly the same amount of money. There's been no growth in its profits over a decade, and in that time we've had an enormous increase in the number of people using mobile phones.
I was just going to say the composition will be dramatically different.
It's gone from 8 million to 22 million users of mobile phones or mobile phone monthly services. Internet penetration into the household has gone from something like 30% to 85% in the last decade. And pay TV didn't exist 10 years ago, and now it's in 50% of households.
We like to call it subscription television.
Subscription television, then. We'll call it whatever you like, Richard. And despite all of those things which Telstra has exposure to, it hasn't been able to lift its profits.
Right.
So where are the competitive advantages? Where's the monopoly characteristics in the profit figure? I can't see it. And when I look at the chart that I've got here of intrinsic value over the last 10 years, the value today is the same as the value 10 years ago. It hasn't changed at all. And so people buying the stock today, liking the dividend yield or believing that the value is a lot higher, they're sadly mistaken. The value of this business is currently its price, and it really hasn't done anything. Now, if it hasn't made a lot more money in that growth scenario that I described over the last 10 years, well, who knows what the next 10 years holds, but it's going to be tougher, not easier, I suspect, for them to make money.
Calling for questions for us to ask Roger Montgomery. So here are some of them. Andrew in Adelaide asking, what is your opinion on Australian-listed REITs, in particular Valad Property Group? Have we seen the bottom, and when can we expect some upside going forward? Roger?
I'm going to make this really simple. I've put together my sheet on this particular company. The intrinsic value doesn't rise above zero at any point in the next... Oh, actually, it's 6 cents in 2012. It's a low-quality balance sheet. It gets a C rating by, A, B and C.
Right.
I give it a C rating in terms of quality. Out of my performance assessment, if I was going to rank them 1 to 5, one being the highest, it gets a 5.
Okay.
It gets the lowest, and its intrinsic value is currently 0. Next year expected to be 0. And in 2012 expected to be 6 cents. It's currently trading at 10. Look, I hope for people who bought it at much higher prices that it is the bottom. But for me, this is just not an area that I would... This is not investment grade. Okay,
got just enough time for one more question. It comes from Greg, who also posted this via our website, but through Facebook, because he noted the update on Facebook. Roger, are you an analytical investor? Well, you are an analytical investor who looks for undervalued companies. Do you place stop losses to protect yourself against irrational market movements, or do you stand by your value analysis regardless of the weather and wait for things to turn around?
Okay, I hate doing this, but there's 5 rules that I've got for when to sell.
Okay.
Stop losses aren't part of that. One of them, for example, is that the value of the business declines from the previous year. So the value goes down, and when you look out a couple of years, the value isn't expected to recover. That is a signal to sell. If the price is significantly above intrinsic value, 20, 30, 40, 50%, and the value is only going to be rising by a couple of % a year, well, there's another combination of scenarios where that would be an indication to sell. Now, people think that's a contradiction to the sort of thing that Warren Buffett does, which I'm a huge fan of. But in fact, Warren Buffett said publicly, I made a big mistake not selling some of the things during the Great Bubble. And so there's 5 rules. We haven't got time to go through all of them. We might do it next time. But yeah, stop losses don't play part of it.
How about we do that next time, the 5 rules?
Fine.
Deal. All right, Roger Montgomery, appreciate your time. Thank you very much. Roger Montgomery there from rogermontgomery.com.